Back now with Matt Tucker talking about investing in bond ETFs. Matt is BlackRock's Managing Director of U.S. Fixed Income Strategy. He joins us from San Francisco. Brian Luke is also on hand. So, Matt, what do you think the most important thing investors need to keep in mind while investing in these fixed income ETFs? And what do you think the biggest misconception might be as well? Two-part question for you.
Well, I think the most important thing to keep in mind is what an investor wants to achieve with their investment. I think the great thing about fixed income ETFs and iShares is they allow an investor to really customize their investment. So if an investor wants to build a diversified portfolio, they can do that. If they want to express a particular view on a market, they can do that. But the investor has to keep in mind really the balance of their portfolio, the risk in that portfolio, and what it is they want to achieve. I think one of the big misconceptions in the market, and I think there was an allusion to this earlier, is that these are day trading vehicles. I mean, the reality is if you think about the fixed income markets, it's an over-the-counter market. It's opaque. It's costly to trade in. We've taken that market and brought it onto an exchange to provide liquidity, transparency, and access. I think that's just a great way for any investor, whether they're a day trader or a buy and hold investor. And Matt, it's a great way to kind of focus on who's actually buying what when you see the asset flows. Last year, $10 billion into the TIP, ETF, TIP, or just that type of security, as well as $10 billion into corporate exchange-traded products. So what's the 2010 ticker symbol that's going to you expect to grow the most? Is it the Muni bond? That's always ETF, a hard call. I do think muni bonds are going to have a very strong year. If you think about the trends we're seeing, so investors are concerned about rising interest rate. Investors are concerned about potentially increasing taxes. So I think investors are going to be turning to products that provide income like muni bonds. And that's why we're very excited about this muni series, because it's a way for investors to access this market, get a lot of the benefits they associate with individual bonds, but to do it with an ETF that provides all the benefits that we provided through our existing products. And that's really interesting. And you talk about who's buying this. A lot of these are for personal investors, but there's a lot of professionals buying your products as well. A lot of them are getting in and moving out quickly. Do you see a trend in terms of the professionals, the institutionals, the hedge funds going out and buying the different index ETFs, and then the personal investors following in? Or is that just a myth? No, it's actually pretty balanced. I think if you look at the data, about half the investors in these funds are retail, individual, and about half are institutional. I mean, the reality here, and I don't think the market really is aware of this, but it is cheaper to buy fixed income asset classes through an iShare, an ETF, than it is actually buy bonds directly. You can transact in U.S. Treasury bonds cheaper through an iShare than you can by buying Treasury bonds in the secondary market. And that's something that institutional investors and retail investors both benefit from.
Matt, are these ETFs vulnerable to speculators?
Well, this is actually one of the nice things about the ETF structures, So ETFs are designed such that they will trade in line with the value of the underlying securities. And this is something that's been tested in multiple sectors, whether it's equities, fixed income, commodities, across markets. This structure works. These securities, basically ETFs, will trade in line with the underlying through different markets.
Could regulation shake up the industry?
Thank you. Sorry?
Could regulation shake up the ETF industry, fixed income or whatever kind of ETF
potentially, Potentially, but I think actually regulation is actually driving, a lot of the interest in ETFs. Think about what they provide. They provide transparency into what you hold. Think of that last year when a lot of investors were surprised what they had access to or had invested in, whether that's subprime securities or auction rate securities. Investors now can invest in something where they know exactly what they're holding and exactly what they have access to. Same thing with liquidity. There's a drive towards liquidity. Investors want to be able to exit securities if they're concerned. That's what iShares provide. So I think that if there's more regulation, that's really good for the industry.
So Matt, one quick question. Do you think the leverage ETFs are going to really come up, and are those good for personal investors, yes or no?
I think that leverage ETFs do what they say that they're going to do, which is they provide a leverage return on a daily basis. I think that's only suitable for some investors, though, who understand the mechanics of leverage and understand the implications for their portfolio. I think the challenge is a lot of investors have used these products and not understood what they are, and they've actually been very surprised by the results. So I'm not really against the idea, it's the application.
Running up against our break. Matt Tucker, Brian Luke, thanks, guys.